Hi, this is Todd Baker, your certified mortgage, and in this video I'm going to talk about how mortgage rates are determined or what determines mortgage interest rates. So in the general public, there is a widespread belief, probably the number one belief, is that mortgage rates are determined by the Federal Reserve, and that's not true. The Federal Reserve sets policies on how banks borrow from each other and how they borrow from the Federal Reserve. And that does affect the economy. That has an indirect effect on the bond market that can then affect mortgage rates. So that's sort of a mouthful, but the point is that when the Federal Reserve raises or lowers interest rates, it doesn't have a direct impact on fixed rate mortgages at all. The other thing that people tend to believe is that the 10-year Treasury is what determines mortgage rates, and that's not true either. Now, what determines mortgage rates first and foremost is the bond market. They're established mortgages or bonds, just like U.S. Treasuries. They're traded at the Chicago Mercantile Exchange in the same market that U.S. Treasuries, and they tend to trend along, but they also can diverge, meaning they're not directly linked. What's directly linked to mortgage interest rate is mortgage-backed securities, and so what we do is we get a live feed and it shows a chart of rates going up and down. But that's not the only factor. There are also other factors, and the biggest one you're already going to know, and that's your credit score. Your credit score is the number one big factor, but there's other things like how much down payment, the size, the purchase price, and the loan amount. So smaller loan amounts tend to have slightly higher interest rates, the way they get adjusted. Those are all market-based adjustments. Another one is the term of the loan. So for example, a 30-year will have a little bit higher interest rate than a 15-year note. And there are adjustments. I'm going to show you, just to give you one quick example, on a conventional loan, show you what I mean. So 760 and above is considered perfect credit for mortgages. So you can see at credit score, in this case, greater than 740 credit score and 60% loan to value or less, meaning 40% down. You can see there's no, really, if you put 40% down, there's no adjustments. So here's a great example. Put 40% down, there's no adjustments to your score falls to 640 or 6 or and below. If you put 30% down, there's slight adjustments, but see they're small, and then as your score drops, you can see here's the score buckets, the interest rate increase, and it goes up. So for 25% down, it's higher, and 20% down, even higher, right? And it gets a little bit better at 20% or 15% down or less. So these are all the kind of adjustments. So the point is you need to be working with an expert that understands the market. It understands when to lock in your interest rate, that understands and has your best interest in heart in selecting a loan program and down payment option, because there's a lot of factors that go into making that decision, not just based on credit score, but cash on hand. There could be a situation where you can afford to put 20% down, but it's every penny that you have. It might be smarter to put 15% down. Those are the kind of things that a mortgage planner, a certified mortgage planner like myself, can help you determine to make great decisions to build wealth for you and your family. So I hope you found this helpful, and please feel comfortable reaching out to me anytime with questions. Thanks so much. Bye-bye.